name is Otaviano Canuto, and I'm a senior fellow at the Policy Center for the New South. This is the sixth of a series of short videos dealing with subjects covered in my recent book, Climbing a High Ladder: Development in the Global Economy. Today, we approach why central bank balance sheets have swollen so much since the 2008-2009 global financial crisis, further bloating during the pandemic last year. Such bloating of central bank balance sheets can be seen as consistent with the rise of finance and of private balance sheets relative to GDP that we approached in our previous video. Look at the case of the Federal Reserve Bank. Well, but in general, central banks of advanced and many emerging market economies have gone through a period of extraordinary expansion of balance sheets. When the global financial crisis hit the international economy in 2008, central banks in major advanced economies widened their range of monetary policy instruments, increasingly resorting to unconventional tools, initially to avoid a deepening of the financial destabilization and bankruptcy of solvent-but-illiquid private sector balance sheets, as it happened during the Great Depression of the 30s in the last century. Subsequently, to fight economic stagnation and deflation risks as private agents deleveraged, then the US Federal Reserve Bank, the Fed, the European Central Bank, the ECB, the Bank of England, and Bank of Japan, at different moments and intensities, implemented programs of massive purchase of government securities and/or private assets from markets, with simultaneous creation of bank reserves on their liabilities sides, which is the quantitative easing. Central banks' policies seem to shift towards including financial stability as a goal, while uncertainty about counterparty risks remain elevated. Counterparty risk is the probability that the other party in an investment, credit, or trading transaction may not fulfill its part of the deal and may default on the contractual obligations. Under circumstances of shocks and financial crisis, its perception goes up the roof and frees credit flows, exacerbating bad conditions. In the 30s, this led to many otherwise solvent firms becoming insolvent because of a liquidity drought. So, this time, crisis-hit economies saw broad liquidity provision to domestic banking systems through the QE, the quantitative easing, with this QE later evolving into a tool to boost the efficacy of interest rate cuts. Together with forward guidance, debt swap programs, lines of long-term loans to banks, and later in the Eurozone, negative interest rate policies, such use of unconventional monetary policies led to an extraordinary expansion of central banks' balance sheets, as you can see in the case of the US Federal Reserve in the chart. First, central banks' balance sheets expanded by supplying reserves to ensure smooth settlement of financial transactions. Because of the elevated uncertainty about counterparties' solvency, banks hoarded their reserves instead of lending in interbank markets, also to self-insure. So this phase of the central bank balance sheet expansion could be seen as liability-driven, that is to say, originated from policies aiming at central banks' liabilities. The second wave of expansion came from the QE per se. Policymakers bought assets to reduce long-term interest rates and shift portfolio compositions. Those asset purchases were financed by creating reserves, making this second expansion of the central bank balance sheets an asset-driven one. While the liability-driven bloating balance sheet QE might be seen as quantitative stabilizing, the asset-driven phase is the true quantitative easing, as it intended to bring down long-dated interest rates, like the 10-year Treasury yield, that drives mortgages and other consumer borrowing costs. The asset composition moved from government bills only to various types of bonds and equities, with difference between central banks reflecting underlying structural differences in terms of the shape of local financial markets. Countries' weight of bank intermediation versus capital markets, as well as the shares of government bonds in private portfolios, vary. In the Eurozone, institutional weaknesses, such as the incomplete fiscal integration, defragmentation of the banking system, and risks of country exits generated additional challenge for the ECB policies, for the European Central Bank policies. Then comes the coronavirus pandemic and the financial shock last year, when a dash for cash led investors to liquidate whatever riskier assets they had and take refuge in short-term safety haven assets. The Fed announced on March 23rd, 2020, that it would buy an unlimited amount of US government bonds and mortgage-backed securities. It also announced that it would purchase corporate bonds, including debt with a junk credit rating, and even provide financing directly to individual companies. As a result, the fact of the matter is that the Fed's balance sheet rose from around $800 billion before the global financial crisis to over $7.57 trillion today. And this is not, of course, only the case of as I mentioned, of the Federal Reserve. Also, other central banks of advanced economies resorted to unconventional monetary policies and the corresponding bloating of balance sheets. The size and responsibilities acquired by central bank balance sheet operations also reflected an over-reliance on monetary policy to support macroeconomic recovery. Opportunities to resort to fiscal policy as an additional engine were not taken, either because of the choice of fiscal austerity in the Eurozone as a whole, or because of early pursuit of consolidation. In the case of the US, Congress blocked President Obama's infrastructure investment plans and imposed fiscal restraint, something that also happened in the United Kingdom. To be seen now, as President Biden has got the approval of his fiscal package, how and if this over-reliance on monetary policy in the case of the West will be something of the past. In any case, most analysts agree that besides precluding deep downward spirals of debt deflation and bankruptcy, its transmission, the transmission of the QE through lower debt service, positive wealth effects, and weaker currencies, in the case of the euro and the yen, contributed to an economic recovery, including by helping banking, household, and corporate leverage in countries that adopted those unconventional policies. The size acquired by central bank balance sheets was to some extent a flip side of the oversizing of domestic and international private portfolios built up in the run-up to the global financial crisis, the unwinding of which would have been even more disorderly otherwise. The incompleteness of such unwinding, including debt restructuring and consolidation of portfolios, helps explain the relative feebleness of recovery in the extended time horizon of unconventional monetary policies in the Eurozone. As we approach in our previous video on the big balance sheet era, this also seems to be at play on the other side of the Atlantic. Now, After more than a decade since unconventional monetary policies began to unfold, you might ask when the policy agenda will shift to exit strategies. The Fed started to gradually hike interest rates in 2017 as the US economy came close to full employment, and apparently started the path of unwinding its balance sheet, as you can see clearly in the trajectory of the big balance sheet in this chart, until it backtracked in the latter part of 2019. And of course, now with the pandemic, it reversed the way back to quantitative easing. Well, in the case of the European central banks, central bank, as well as other like the UK, the Bank of England, and the Bank of Japan, we also had not only the pandemic, but also, let's say, the talk about unwinding the balance sheet, bloating, is not in the immediate horizon. Now, there are good reasons to believe that there will be no return to the pre-quantitative easing configuration of balance sheets. Together with pro-recovery justification for central bank policies, structural and regulatory factors have contributed to their balance sheet dynamics and made central banks not just market regulators, but also quasi-market makers. First, the increasing global financial integration in the last few decades has imposed increasing challenges in terms of making liquidity management effective as cross-border volumes of capital flows have expanded significantly. Down in the series, we will dedicate a video to financial globalization. Second, a reason to believe there will be no return to the pre-QE configuration of balance sheets. Changes to financial regulation have induced private agents to alter their behavior and strategies. For instance, Basel III requires banks to hold a minimum amount of high-quality liquid assets, which could be met by simply holding reserves at central banks. These rules have discouraged banks from receiving short-term cash balance from institutional investors and have made central banks the only remaining player able to provide liquidity service. Third, central banks might need to accept an increasing role as funding providers, as banks are not incentivized to use short-term balance for arbitrage trades. Thus, a new task has become under the purview of central banks, monitoring relationships between various benchmark curves, that is to say, operating as quasi-market makers. One may expect that the new normal configuration of central bank balance sheets will not necessarily be as bloated as during recent abnormal times, but central bank balance sheets will not return to the pre-global financial crisis sizes and profiles. The big balance sheet economy that we saw in the previous video is not friendly to such a hypothesis. Well, and look, and as I spill over from abroad, central bank balance sheets in emerging market economies also bloated. Let me show you the cases of three of those, Brazil, but also India, and also Mexico, and we could depict here several other cases. In the case of emerging market economies, the issue is that right after the unconventional monetary policies started in advanced economies, there was a collateral effect, which was the shift of abundant liquidity to other countries, small advanced economies like Switzerland, and emerging market economies, mostly casual by standards at that point, right after the global financial crisis, until the 2013 taper tantrum, which was a shock on capital flows to emerging market economies, displaying at the time current account deficits, when the Fed announced that it would then start considering unwinding QE. Until then, liquidity excesses eventually turned into massive capital flows to those countries, and they have never been fully reversed. Before the global financial crisis, Capital inflows had already led to a piling up of foreign currency reserves in recipients, particularly when accompanied by high current account surpluses. After a slowdown in the immediate aftermath of the crisis, those flows and the corresponding reserve accumulation returned strongly for some time until slowing down again more recently. And it's worth remarking the greater weight of short-term flows and bonds purchases in the QE-influenced wave compared to previous periods. In any case, accumulation of reserves with corresponding central bank balance sheet accommodation became the norm. Holding up against local currency appreciation while sterilizing monetary impacts of reserve accumulation meant expanding the balance sheets of recipient emerging markets, an asset-driven increase of the central bank balance sheet. That was a major factor behind several emerging markets' central bank assets reaching proportions of GDP comparable to those of economies that adopted unconventional monetary policies. Anyway, the era of bloated central bank balance sheets seems to be a component of the new normal, even if they undergo some diet in the future. Well, you can find a discussion on bloated central bank balance sheets in chapter 5 of my book that you can find on those places listed on this slide. In the next video, we will approach the evolution of global current account imbalance. Stay tuned.